Most first-time homebuyers fall into the same trap by scrolling through Zillow long before they're actually ready to buy. They find properties they love and they spend months imagining their lives in these spaces, only to get emotionally attached to something that might not even be an option. When they finally decide to get serious and reach out to me, we pull their credit, run the numbers, and that's when I often have to deliver bad news. They simply do not qualify for the homes they've been looking at, which means months of their time was wasted on a dream that they could not actually secure. My background in public safety taught me that every mission needs a clear plan before you ever move towards the objective. Buying a home works exactly the same way, and you need a solid blueprint in place before you start your search. That's what we're walking through today, so you can understand the strategy behind the process. By the end of this video, you'll know what lenders are looking for, why those requirements exist, and exactly what you need to do to get pre-approved and ready to buy. To understand the strategy of a modern mortgage, we have to look at why lenders are so strict today. If you wanted to buy a home back in the early 1900s, you usually needed 50% of the purchase price in cash as a down payment just to get started. Most of those early mortgages were 5-year balloon loans, which meant you paid interest for 5 years and then you owed the entire balance all at once. These loans were short-term and incredibly risky. So lending standards were basically just whatever the bank felt like doing at the time. Everything changed after World War II when the government introduced backed loans to make homeownership accessible to regular people, which opened the door to millions of families. However, we eventually hit the 2008 crisis where lending standards became far too loose and banks were just handing out mortgages to people who could not afford them. The resulting collapse devastated families and the entire economy. That crisis taught the industry a very hard lesson about risk management. Today's regulations exist because of what happened during that crash, and lenders are no longer just handing out money to anyone who walks through the door. Understanding that mindset changes how you see pre-approval, because it's not just a pile of paperwork, but rather your strategic clearance to enter the market. When a lender signs off on your pre-approval, they are verifying that you can handle the debt and that you meet the standards designed to protect you from financial ruin. Lenders evaluate your file based on 3 specific pillars to ensure that you are a sound investment. First, they look at your ability to pay by reviewing your income and your work history to see if you can sustain the monthly payments over time. Second, they check your willingness to pay by looking at your credit score and your payment history to see if you've handled your past debts responsibly. Finally, they look at your cushion for when things go wrong, which includes cash reserves and your debt-to-income ratio. They want to know if you have a buffer to protect yourself if life happens or if an emergency comes up, and these 3 pillars are what we're going to need to break down. We need to start by looking at your credit and payment history because that's the first thing a lender is going to examine. Many people are afraid of the hard credit pull, but you shouldn't let that stop you from moving forward. While it's true your score might drop a few points, we can develop a strategy around the timing of that pull to make sure it serves your long-term goals. FHA loans tend to be much more forgiving if you have some rough spots in your past, whereas conventional loans are going to require a stronger overall score. If your credit isn't where it needs to be right now, we can build a clear plan to improve it before you ever submit an application. Things like late payments, high credit card balances, or old collections will hurt your standing, but every one of those issues is fixable with enough time and the right approach. Next, we have to look at your income and work history to ensure the lender sees you as a stable investment. Most banks prefer to see 2 years of consistent employment in the same field, but that's not a hard and fast rule for every single borrower. Your specific situation is unique, which is why having an honest conversation about how you are paid is so important for the process. You're going to be treated differently by a lender if you're a W-2 employee compared to someone who is self-employed or working in the gig economy. One thing I need you to hear clearly is If you are thinking about changing jobs, we must discuss the timing right away. You'll almost certainly want to wait until after the loan closes before a career move, because a career move in the middle of a transaction can completely kill the deal or complicate the process. That brings us to your debt to income ratio, which is often called DTI in the industry. This is the primary metric that determines how much house you can actually afford to buy. Lenders take all of your monthly debts and divide them by your gross monthly income to see how much breathing room you have left. This calculation includes your car payments, student loans, and credit card minimums, along with what your new mortgage payment would be. We usually aim for a DTI around 43 to 45% on a conventional loan, but modern programs can actually push that higher if your overall profile is strong. Some conventional loans can reach 50% DTI with excellent credit and solid cash reserves. And FHA can even stretch it to 57% with automated underwriting approval. The key is that your entire financial picture has to be solid, not just one number on paper. This is where we get tactical with your finances, because paying down a specific debt before you apply can dramatically improve your qualification. Sometimes tackling a small car payment or a specific credit card now is the key to qualifying for a much larger mortgage later. Then we have to talk about the actual money required to get to the closing table. Down payment requirements range from 0% for VA and USDA loans all the way up to 20% for a standard conventional loan. A lot of people still believe that 20% down is a requirement, but that is actually quite rare with the majority of buyers I work with today. You need to account for closing costs as well, which typically run between 2 and 5% of the total home price. Beyond that, some lenders might want to see reserves, which is extra funds in your savings equal to 1 to 6 months of mortgage payments. This is what I call the reserves trap, where you scrape together every penny you can for the down payment only to realize you have nothing left for the bank's requirements. We need to plan for the entire financial picture up front so you're not caught off guard at the last minute. To simplify the transition, let's break down the 4 main types of loans that you'll likely encounter. Conventional loans are usually the best fit if you have strong credit and a stable income, offering the most flexibility even though they might require PMI, which is private mortgage insurance. FHA loans are a fantastic tool for first-time buyers who are navigating credit challenges because they allow for lower down payments and more flexible guidelines. While you pay mortgage insurance on an FHA loan, these products often carry a lower base interest rate than a conventional loan, and it saves you real money on every single monthly payment. If you're a veteran, the VA loan is almost impossible to beat. It offers 0% down and no monthly mortgage insurance. Finally, USDA loans allow for 0% down in specific rural areas. However, they do come with strict income limits and debt requirements that we would need to verify. I see this scenario play out constantly in this market. It's frustrating for everyone involved. A buyer finds a home they absolutely love online, and they get emotionally attached to the idea of living there before they ever talk to a professional. They reach out to an agent, we finally get them in front of a lender, then we have to have the conversation nobody wants to have. They simply do not qualify for the home they've been dreaming about for weeks. They've spent months imagining their life in a house they cannot actually buy. And now we're forced to start back at square one. That wasted time and emotional energy weighs on everyone. It's a situation that's entirely avoidable with the right strategy. But here's the thing that changes everything. Reaching out to build a plan before you ever start the physical search. When we sit down to look at your goals early, we can identify those credit or debit hurdles while there's still time to fix them. My background has taught me that staying calm and having a solid plan is the only way to navigate these transitions successfully. By the time you find that perfect home, you won't be guessing if you can actually afford it. We will have already secured your foundation. If you're ready to start your strategic search and you want to move forward with confidence, reach out to me directly so we can put your custom plan in place. Let me walk you through a case study that proves why a clear strategy is the only way to navigate a complex transition. A couple years ago, I worked with a buyer who was stuck in a cycle of renting despite having a very stable job. She convinced herself that homeownership was out of reach because her credit had some rough spots and her student loans were weighing her down. When we first looked at the numbers, her debt-to-income ratio was sitting at about 52%, which is a difficult starting point for a lot of traditional loans. She reached out because she wanted to understand what homeownership actually looked like from a financial perspective, not because she was ready to sign a contract that day. We sat down for a real conversation where I didn't push her towards buying, but instead I simply laid out the reality of her situation and the strategic path forward. Our first step was looking at her credit to see the actual numbers because we needed to see if that rough credit was a permanent wall or just a hurdle that we could clear. Once we identified exactly what was hurting her score the most, we built a tactical debt paydown plan that focused on efficiency rather than just spending money. She had a car loan and several credit card balances, but we didn't try to pay off everything at once. We were strategic about which debts to tackle first so we could move that DTI down while simultaneously increasing her credit score to her target range. After that, we looked at down payment assistance programs that fit her specific profile. She eventually qualified for a program that helped with the down payment and closing costs, which changed the math for the entire transition. We spent time going over the pros and cons of these programs, including the fact that there would be restrictions on the property and a shared appreciation clause. No one was going to just hand her money for free. But this specific program was designed for her exact profile, and it made sense for her long-term goals. Over the next couple of months, she strategically paid down about $3,000 in debt, which caused her score to climb and her DTI to drop to 41%. Because we had a plan in place, we were able to lock in a loan and find a property that was a great fit for her lifestyle. If she just started scrolling through listings on Zillow and getting emotionally attached to homes that she couldn't qualify for, we'd still be talking about why her dream didn't work. Instead, she's a homeowner who's building equity instead of paying rent. And that is the fundamental difference between having a plan and taking a gamble. This is exactly why I emphasize the preparation phase so heavily, because you gain an unfair advantage when you lead with strategy instead of emotion. When you sit down for a real strategy session with me, we don't start by looking at houses. We start by getting to know you and your specific goals. I want to understand what's driving this move, whether it's a growing family, job change, needing to be closer to specific schools. Understanding the why behind your move matters because it shapes every single tactical decision we make together. This is also the point where we figure out if we're a good fit to work together, as I'm not here to push you into a transition that doesn't make sense for you and your situation. Once we have a firm grasp on your goals, we move on to separating what's truly important in a home from what's simply a nice feature to have. We need to know if certain features are non-negotiable, like a specific school district or a certain type of neighborhood, before we ever look at a listing. This distinction becomes very important quickly because your loan type can actually limit which homes that you can qualify for in ways a lot of people don't realize. For example, FHA loans have a safety inspection component built into the appraisal process that goes beyond just checking the home's market value. The lender is looking for specific safety concerns, and certain property conditions or issues can completely disqualify a home from FHA financing. What does that actually mean? They're checking for things like peeling paint on pre-1978 homes, missing handrails on stairs with 3 or more steps, or a roof that won't last another 2 years. If you fall in love with a home before knowing these requirements, you might find yourself in a position where you unfortunately cannot buy the house you want. After we've mapped out your priorities and deal breakers, we have an honest conversation about your qualifications and any potential issues that might arise. We look at your income and your work history through the same lens a lender uses, so they have no surprises and there's no fear later on in the process. We calculate your actual debt to income ratio, and we talk about cash reserves that you'll need to have in the bank after closing is finished. We take a look at the whole cost. This allows us to identify which loan type fits your life best, whether it's conventional, FHA, VA, or a USDA loan. If there's gaps in your profile, we identify them early so we can fix them. Maybe your credit needs 3 months of on-time payments to hit a certain tier. Or maybe you need to pay down one specific credit card to balance your ratios. Then we can make a strategic decision. Are you ready for a formal pre-approval right now? Or do we need to work on a plan? There's absolutely no shame in needing more time to get your finances in order. And we'll build a clear, actionable timeline for whichever path makes the most sense for you. We also explore down payment assistance if it fits your situation, but I'll never push you towards a program just to fill a quota. Many down payment assistance programs are set up as deferred payment second mortgages, which means repayment gets triggered the moment you sell, refinance, or move out. That could be an important point. If you plan to refinance in a few years when rates drop, you need to know that the balance would become due at that time. You need to understand exactly what you're signing up for, and that honest communication is the difference between a real strategy and just being sold a product. The goal isn't just to get you a pre-approval letter tomorrow. The goal is to ensure you're genuinely ready to succeed. When you understand the requirements and you've built a solid foundation, the homes you look at will actually be within your reach. If you're thinking about buying a home, you shouldn't start your journey by scrolling through Zillow. Real success in this market begins with a clear plan, and providing that roadmap is exactly what we focus on during our initial strategy session. You can click the link in my description to book a time on my calendar, and that link will ask you a few brief questions up front so we can make the best use of our time together while mapping out every single step you need to take. We will also take the time to look at down payment assistance programs to see if they are a fit for your specific situation. If you want to explore those options, I've included a simple form in the description that keeps your information completely confidential. We're just gathering the necessary details to have an honest conversation about whether these programs actually align with your long-term goals. This strategic approach is what separates buyers who waste months looking at homes they can't afford from buyers who move forward with total clarity and confidence. Your strategy always comes first, while the actual search comes second, because that's how you truly win in real estate. I'm Robert Clements, and I guide transitions. Let's start yours today with a real plan.